Let's get started. Okay, on Monday we covered the first a third of Chapter 5. We focused on purchases related entries for merchandiser's business. So remember that I mentioned in the beginning of the chapter, we're now moving on to understanding how to do accounting for not just service type of business, but also for retail stores, for merchandisers company. Okay, so this slide here is a summary of where we left off from on Monday. So remember that inventory accounts will be effective for multiple different types of events that relates to purchase entries. So we have the original purchase cost that will definitely increase inventory accounts. Then in case there's returns and allowances, in case the goods that the company received is not up to their standard, or basically it's a wrong shipping entry, the wrong batch of inventory. And returns and allowances is amount that you deducted from, you either ship back to the seller, or you likely get a refund from the seller where you reduce. So also the inventory account. And then afterwards, we pay the amount of accounts payable. If it's within a discount period, if the buyer grants you a discount period with a certain percentages of discount within, let's say, 10 days or 15 days, if you do pay within a period of time, then you get part of the inventory cost off as well. Okay, so if the original purchase cost was $1,000, let's say, and then you return $100 worth of inventory, at the end you get $10 of discount. Then altogether the inventory cost really is $1,000 minus 100 minus 10. Then any freight charges will be additional to that. Okay, freight charges also is an additional cost to inventory. So think of yourself purchasing anything online. Usually freight charges is paid by the party of the purchaser. Okay, so there are two types of freight charges terms. It could be FOB shipping point, and the other one is FOB destination. Okay, so FOB shipping point, purchaser will be the side paying the freight charges. They have the title of the goods starting from the beginning of the shipment process. FOB destination, today we'll be focusing on more. If we're switching roles to the seller side, and we are the party paying the cost for the inventory that we're trying to sell to customer, then this will relate to FOB destination, another type of shipment terms. All right, so on Monday at the end, we covered this problem here. We have the original inventory cost, $185,800. Then there's credit terms, 210, net 30. We talked about the cost of inventory purchase, cost that we're paying within the discount period or after the discount period. Okay, remember that you have the original purchase amount, and if you do an inspection very quickly after receiving the goods, usually that happens within a week after the company receives the goods, if you realize the part of the inventory that is not what they ordered, or it's possibly damaged, that is not useful for their store, for their target customers, and then reduce that amount. And then if that is after the discount period, that will be it for this problem. Okay, the total cost of inventory will be the original cost minus the part that you returned to the company. Second case here is if we do pay within a discount period, you get a few percentages off, 2% off, let's say. And here you reduce the inventory cost by an additional $3,000 more. Okay, so this cost of inventory with discount is paid within the period of time, within 10 days. Then you get 2% off of the inventory cost after the fact of considering the part that you return to the seller. Okay, so if we move this problem into journal entries, how do we journalize the first event, purchasing this batch of inventory? What are the accounts that we would use for purchase entry? The same problem A here. Let's try to recall what we do under A account. Under A circumstance, purchase goods, July 8th. Would we debit inventory? Debit inventory. If you see credit terms, then that will give you a hint that this is not a cash entry. So if it's not cash, we're purchasing something on accounts, so it will be liability, and specifically accounts payable. Okay, so this first entry here In the problems, if you don't see on account term, but you see credit term, the 210 net 30, and that basically means that this transaction is not a cash transaction. Because if it's a cash transaction, then there's no point of stating the 210 net 30. Seller would not need to encourage the purchaser to pay the money in advance because they readily paid it. Okay, so credit terms is a hint there for you to know that this is not a cash purchase entry. This is an entry that your company has not yet paid the amount. This is on account, which is why you see the credit term. Okay, so July 8th, this is a purchase entry, increase inventory, increase accounts payable. Now when it reaches 4 days later, they did the inspection, they realized they need to return some of the goods, and the seller also wants to keep the damaged goods, possibly if they could maintain it or fix it in a way to then resell it to other customers, they may want to collect the goods. So if that's the case here, in terms of returning the goods, if you're the company that earlier purchased the goods and now you're returning it back, how would this affect your inventory account? Would it be increase or decrease? Decrease, because you're returning it. So definitely you know that inventory will be the account being reduced. So what's the other side? At the same time, if you ship back the goods to the seller, then of course you're not responsible to pay that amount of money either later on, right? So accounts payable earlier was $185,800, but after shipping the goods, a portion of that you return it to the seller, you're no longer responsible to pay back.
So would accounts payable be debited and then returns and allowances be credited?
Accounts payable will be debited, and then the idea is returns and allowances will be captured under inventory account. So yes, this is returns and allowances, but keep in mind we don't have a separate account here. Okay, so any returns and allowances will be captured under inventory accounts. We directly decrease inventory value. Okay, so we're trying to recognize that inventory's cost is no longer $185,800. What we have on hand is no longer this amount of value of inventory. So we reduced it by the part that we ship back to the seller. So the transaction happened July 8th. 4 days later, you return a part back. 3 days later, you're trying to pay this full amount of this transaction of inventory. So if you match the first day to the very last day, has it exceeded 10 days? Exceeded 10 days? Not yet, right? If we had a transaction 8th and the discount period is within 10 days, that means as long as we pay within any time from July 8th to July 18th, then we're still within the discount period. We can get that 2% off. Okay, so this last transaction here, we are paying off this amount. We're using cash, definitely, but we're reducing accounts payable at the full amount. For the cash amount, we're not paying in full. Okay, we're getting 2% off, meaning that we're only paying 98% of the inventory cost. Then the remaining, the differences between this will be considered inventory discounts. So again, we capture this under inventory accounts. All these 4 events here, purchases, freight charges, discounts, returns, we all use inventory to capture this. It's either debited or credited. If it's returns and allowances, any discounts that we get, we recognize that inventory's cost will be reduced. Okay, because we're not really paying this $167,270, but we're paying this. Okay, 98% of that. So if we post all these entries to their specific T accounts, and if we just look at inventory account here, you will see $185,800, the original purchase price. This was the first entry. And you realize that part of the goods are damaged, $18,530. This we'll reduce inventory account. Then at the end, when it reaches payment, make sure that you understand whether this transaction is paid within the discount period or after. If it's after, then it will be completely just that amount minus the part that you're returning. You'll be paying that in full with cash. For this case here, we are paying within the discount period, so you get 2% off. It's $3,345. So inventory account here will be reduced by this amount, 2%. So the inventory, the T account will look like that after posting these journal entries. So the next question for this problem here was, in final analysis, how much did the inventory cost this company? So overall effect of all these three transactions. Now, this problem didn't mention freight charges, so you don't have to worry about freight charges. This particular problem, we don't have the case. So the overall analysis for inventory cost here, you have the original purchase price, you have the returns part, and you reduce the inventory, you have discounts offered by the seller. Overall effect would be using this amount minus this and minus this. Okay, so you have the original amounts. This first line here, cost of inventory kept, is already subtracting the returns and allowances part. Okay, that's why you see 167,270, and then they subtract again the discounts. So the cost of inventory overall will be this balance, 163,925, which is really the cash that you're paying here. Any questions on this problem before we move on to the sales side?
Did you get the 98 or just 100?
Yes, 2% off, so you're really paying 98% of the amount. Okay, so far what we covered is related to the first part of operating cycle. We first have all the purchases made. Then these inventory, after we purchase it in, the main goal is to get sales revenue out of it. All right, so then the next part of this chapter, we're moving on to how to actually sell these inventory to our target customer. And then what are the journal entries that we have to make in sales cycle. Okay, all of these, what we covered so far is purchase cycle. We're dealing with our vendor, our supplier, our wholesaler to get the inventory into the store. Then we resell it to our target customer. Okay, so next part of this chapter, really the corporation is switching roles here. Earlier, we are the purchaser. We're getting the inventory. Now we're moving on to selling it to our target customer. So we're moving on to this part here, selling the inventory. So this slide I showed on Monday as well. We're covering the first part, and we're moving on to the second part, selling inventories. So overall, at the end, the problem that we just talked about was the net inventory cost. The problem that we just solved here was dealing with net inventory cost. Now, if we switch roles to being the seller here, sell the items to customer, then we will have similar events that will happen. We're dealing with our customer now. Customer may be returning some of the goods to you if you accidentally shipped the wrong goods or there's damaged goods in the middle of the transportation process. You may also be granting customer discounts. Okay, it's just that now we're switching roles. We're becoming the seller, no longer the purchaser anymore. Okay, the second part of this chapter. So overall, we also want to know what at the end will be the net sales revenue that we're really getting. Okay, so meaning that originally you might have, let's say, $1,000 of sales revenue generated. You thought you shipped out inventory to customer, you sold it out to your target customer, and you thought you would be getting $1,000 of sales revenue. But then a part of this, let's say, was damaged in the middle, so you granted customer allowances. And then you reduce the sales returns and allowances. And then if you do offer a customer a credit term, encourage them to pay the liability in advance, earlier as possible. You give them discounts, let's say 10%, around 10% of it. Okay, so then overall, the net sales, really the money that you're really getting from customers may not be $1,000. It could be a dollar amount less than that. Let's say $890. So we're trying to deal with the sales side of the cycle. Overall, we also want to know what is the net amount of sales revenue we're getting. Earlier, we're trying to understand what is the amount of inventory cost that we're actually using to purchase the batch of goods. Now we're trying to figure out, based on all the transactions that happens, overall, what's the amount of sales revenue? Because this is really the most important amount that we're getting for merchandisers in order to gain profit. Okay, so let's move on to journal entries. If we, after purchasing inventory, once we start selling it to customers, selling of inventory generates sales revenue. So the first entry we'll need to capture, just like how we capture service revenue in the first 4 chapters. Here for Merchandisers Company, the goal here is to get as much sales revenue as possible and to generate profit between revenue and cost. Okay, so first entry will be dealing with sales revenue amount. Second entry will be capturing the inventory cost that we are reducing from our warehouse. Okay, so earlier we captured these inventory costs. This is the price that we use to purchase goods from our vendor. And then, in the corporation perspective, they will mark up the price, then they sell it to their target customer, generating sales revenue. So there definitely will be a difference between these two, because these two basically, the amount in the middle is the gross profit that we're getting. It's the goal for the Merchandisers Company, how they generate profit. Okay, so for example, you may have, let's say, my company sells, I sell a bottle of Coca-Cola to you, and a bottle worth $1.50. But originally, from the batches of inventory, batches of Coca-Cola that I purchased from my vendor, my supplier, if we spread out the cost, possibly each bottle of Coca-Cola only worth 70 cents. So this is the case, $1.25 and 70. The difference is the profit that we're trying to capture based on these two entries. So you will see $1.25 listed in the first entry as sales revenue, which is the retail price that we're getting from customer. And then the 50 cents or 75 cents, the original cost of the inventory, will be captured in the second entry. And so first entry is the retail price, the price that we're trying to get from our customer. Second was the original cost that we purchased for this good, and we want to capture that inventory as being reduced since we sell the product to customer. Okay, so just keep in mind that these two, earlier the amount of money that we're talking about is the cost of the goods, and now we will be, corporation will mark up a price, have a retail price to sell to their customer. There will be price differences between these two, which is the profit that we're trying to calculate later on in income statement. Okay, so let's take a look at the transactions. Accounting for sales transactions, here's a case of cash sales. Okay, so in case that you're selling items to customer, let's say they're worth $3,000, and we're collecting cash immediately, right then and there. Once this transaction happens, we gave the goods to customer, we collect $3,000 of cash. These will be the two transactions captured. Okay, the first transaction here increases cash, increases sales revenue, $3,000, is the retail price. And the cost, if we match up with the original amount of the goods that we purchased from our vendor, from our supplier, let's say those goods, earlier we just used $1,900 to purchase it from our supplier. So this transaction here you can immediately identify just by this sales event. You're getting $3,000 cash from customer, but the original amount of the goods, the money that you used to purchase it, was only $1,900. So just by this transaction, you're gaining a difference that is how much? 3,000 is the retail price, 1,900 is the original cost that you used to purchase the item. Then the differences here will be the 1,100, right? So this 1,100 will be the first, if this happens January 1st, the first entry. This 1,100 will be the first gross profit gain based on this sales event. Okay, so the first entry is the retail price, the price that you're getting from customer. Second entry was the original cost that you used to purchase from your vendor, from your supplier. The company is trying to gain the differences between these two. So again, on Monday I covered that there are two types of inventory systems, and we're focusing on perpetual inventory system, remember? If we link this to, let's say, a grocery store, the customer comes, they have 10 items in their carts. Once you ring each and every item, the cashier rings each and every item with a barcode, inventory account cost of goods sold will be immediately affected. Okay, so this is the entry that we were talking about earlier. Once the barcode has been scanned by the optical scanning machine, the registers, then the second entry here, inventory level, will be updated. Sales revenue would also be updated. Okay, perpetual system, all these transactions actually will be done automatically and on a continuous basis. So once a customer comes to check out the items, these inventory level will be updated immediately. Now what would happen in the case of selling items on account then? This is a cash entry. What would be the difference here if we're selling on account? What would you change? Switch cash to accounts receivable and anything else? Inventory will still be affected, right? Because if we are selling something on accounts, the only difference is that we're not getting cash immediately, we're getting cash later on. But we are providing the goods, which is why it qualifies as sales revenue, right? Remember the revenue recognition principle? Once we provide the goods and services, it's considered sales revenue, it's considered service revenue. So there will only be one account that's different from cash transaction. We're just switching cash to accounts receivable, we still have two transactions. Okay, so keep in mind that always when a problem tells you or in a situation of selling items, it always affects two transactions because one would capture the retail price, the cash you're getting from your customer. One would capture the original cost. So there will always be two transactions for sales, no exception to this. Okay, because at the end we want to summarize this dollar amount to figure out the profit in between. All right, now cost of goods sold account I briefly mentioned on Monday. Cost of goods sold is basically the expense for inventory. Okay, so it only captures the expense for inventory asset accounts. So it links to this account, very similar to how we talked about, remember in Chapter 3, prepaid expenses. And then you have possibly insurance expense, where supplies asset account, and when you use it, that it turns into supplies expense account. So it's similar to that idea if your inventory, once we purchase it in, if it's sitting in our warehouse, it's considered asset to us. So then once we sell it to our customer, it turns into cost of goods sold expense. You ship it out, it goes into customer's hands, it's no longer in your warehouse, then it goes into expense account. Okay, so this is what this transaction is about. Originally, you have this $2,900 of inventory in your warehouse once you purchase it in from your vendor. And then when you resell it to your target customer, that $2,900 originally was on the debit side. Now you credit it, and then you turn it into cost of goods sold. So this $2,900 here is this entry. The inventory asset, we turn it into cost of goods sold expense account once we sell the item. Okay, moving on. Now other issues, just like purchases side, we may have returns allowances. For sales side, your customer may also return some of the goods, and you may be granting them an allowance to reduce their liability, reduce the accounts receivable that you're getting from them if the goods are damaged in the middle. So it's likely that these two cases would happen, just like how we talked about this on Monday for purchases side. Now the only difference here between this cycle and purchase cycle is that, remember in the purchase cycle everything is captured under inventory account? For sales side, we do have sales returns allowances and sales discounts, two different accounts to capture this. Why? Because under income statement, remember income statement is all about revenue and expenses. This sales revenue is a very important account. It's pretty much the only account that you will see the majority of the income coming from. This, usually if it's a sales business, they wouldn't have as much service type of business revenue generated. So sales revenue, we want to capture this in much details. We will first list the original sales amount, but then any other issues that happen, we want to list it subsequently in other accounts right next to it under the income statement. Okay, so we do have a separate sales returns and allowances. We have a separate sales discount account to capture these two events in case it happens. You will see the dollar amount listed there. Okay, so this gives outside users also more detailed information in terms of where the revenue comes from and why is it reduced later on because of these issues. What is the percentage of the amount under these two accounts? Under the account of sales returns and allowances. Okay, now another difference is that returns and allowances, returns has actually the goods from customers shipped back to you. Allowances, we don't keep track of the goods. You may ask the customer to hold on to the goods, but you still grant them a reduced amount of accounts receivable. Okay, but for the first case here, if you do have returns, actual goods collected back, this will also influence your inventory value. Okay, inventory value will go up. For return case, allowances would not have inventory value affected. Okay, so the next slide I'll be showing you the entry. The general idea here is that both returns and allowances will allow customer to pay less back to you later on. If earlier you thought you provided goods that were worth $1,000, then they returned $100 worth of inventory, then they only need to pay you back $900 later. Or they didn't return to you, you grant them a reduced amount because the goods is completely damaged, then they still only need to pay you $900. So both cases affects the accounts receivable that we're collecting from them.
What if they become a full refund? How would you, journalize that?
Company, if it's completely damaged, you mean entire $1,000, that's also possible. So we're talking about the case of partial, but of course that's between how the seller evaluates this particular event. If the whole thing is completely damaged, then of course it's possible for an entire full refund. Okay? So both cases, with or without the inventory actually shipped back to you, you'll be granting a reduced amount of accounts receivable that a customer will be paying your company. Okay, but in terms of transactions, returns will have two transactions, and if without the inventory received allowances, you only have one transaction. Okay, so for entries here, sales returns and allowances pretty much is flipping the original sales entry because now you're getting the goods back. Okay, so earlier we had sales transactions that looks like this, accounts receivable, sales revenue. Earlier you had cost of goods sold debited, and then inventory. Right, this was the case for sales. For sales returns and allowances, you see that accounts receivable is being reduced for $600, assuming that customer is now shipping back the goods to you that were worth $600. And you have sales returns and allowances, a contra revenue account listed $600 here. For earlier, the transactions that you made that increased sales revenue. Okay, so sales returns and allowances captures the dollar amount of goods that customer is actually returning to you. And the second entry here was the goods original cost. So the 600 was the retail price earlier that you thought you will be collecting from customer, but that part of the goods is not good for them. It's either an error or got damaged in the middle. Later on, you collect it back. This increases your inventory value at the same time by the original cost. Okay, so these two entries really is flipping earlier the sales transactions. Earlier you had service revenue increase, sales revenue increased, and accounts receivable increased. Now you have a reduced accounts receivable, and then the amount that is being shipped back to you will be captured under sales returns and allowances. Okay, same for inventory. Inventory earlier you turned a part of asset into expense. Now you're turning a part back into inventory once the customer ships back the goods to you. So this is the case for sales returns, actually capturing if your company actually receives the goods from customer.
If a customer would return partial damaged goods, who pays for the shipping, back to the...
That depends on originally what was the original credit term, the shipping term. Remember the FOB shipping point, FOB destination. But I would say most likely nowadays it would likely be the seller would be the party paying it. So nowadays there's also customer services that are trying to also grant more trust for customers and advertise their products. So likely it would be the seller, but it could be different cases for corporation to corporation transactions. Okay. Okay, for sales allowances, there will be only one transaction. Okay, we will not be affecting inventory level if for the case that, let's say the goods is completely damaged, you want the customer to just hold on to it, do whatever they want with that batch of goods, but you will grant them an allowance, reduce the money that they need to pay you. So in this case, there will only be one transaction here. We're flipping the accounts receivable, reducing the amount based on the damaged goods value, original value. Okay, so accounts receivable here you see it reduced by $600. Sales returns and allowances also increased $600. Okay, this account here will represent a deduction of sales revenue, and later on we will right underneath income statement under sales revenue account. Sales returns and allowances has a normal balance on the debit side, just because it wants to reduce sales revenue, which has the balance on the credit side. And so this is the opposite. This has the opposite normal balance compared to sales revenue account. Okay, so again, for this case here, since company is not collecting the goods from customer, then we'll not be increasing inventory account. We'll not be adjusting cost of goods sold. Okay, that part, basically, we just think of it as readily shipped out and is no longer useful, so the cost is still there. Okay, but we do grant customer an allowance for $600, so we were reducing accounts receivable that we will be collecting from them. Okay, but we don't affect, this transaction doesn't affect inventory account. All right, so far we talked about regular sales transaction, what is the amount of revenue that company will be getting, how they adjust inventory costs. And then in case of returns and allowances, if this happens, if customer should back the goods, you have two transactions basically adjusting what you did earlier for sales. And then if you don't receive the goods, then just one transaction here. So after this case, once customer reaches the day that customer will pay you back the amount of the goods that they purchased from you earlier. If this is within discount period, we also take care of the amount of discount under another account, another contra revenue account called sales discount. Okay, sales discount, just like returns and allowances, they both have minimal balance on the debit side, just because both of them really reduces sales revenue. Okay, so this case here, earlier we made, let's say, sales transactions that were worth $6,500. Originally, your company should be collecting $6,500. But since the customer pays within 10 days, still within the discount period, then they get 2% off from the $6,500. Okay, so you see in the middle here, if without the discount, it would simply be cash and then accounts receivable. That's all. Without the discount. It would be fully $6,500. Debit cash, credit accounts receivable. Okay, but with this discount amount of $130, then this will reduce the cash that you're collecting from customer, because you're doing customer a favor, encouraging them to pay back the money earlier. So the cash you're getting will not be $6,500, but it will be reduced to $6,370. So it depends on credit terms. If it's 310 net 30 and you're getting 3% off, your company will be getting 97% of the original amount. Okay, but for this case here, they're getting 98% of the $6,500. Okay, so in this case, you'll see sales discount to account $130 listed. Remember again, at the end, under income statement, you'll see sales revenue first, then you have the returns, allowances, sales discounts listed underneath it. These two amounts will be deducted from sales. So it's the opposite side of sales. Any questions so far? Good. In this chapter, there's a lot of transactions, a lot of new entries and new accounts. So make sure that you go back to the handout and try to do a comparison of purchase and sales side. Okay, this week you're not going to have homework, but next week after midterm exam, we'll be doing homework on chapter 5. You'll have both problems as a purchaser, as a seller. How did you do transactions? So make sure you understand which role the corporation is playing when you journalize the entry. Okay, because some of the events are very similar. Both cases you have returns and allowances. Both cases you have discounts. Both cases you could have freight charges. But in terms of what role your company is playing, that will determine which account you're using. Okay, so after midterm, when you review this chapter, make sure to also refer to the handout. All right, the last case here, freight charges. Let me just get the slide here. Freight charges, this is less common, but also likely for company to company, business to business selling events. It's likely that seller will be the party paying the freight charge as well. Okay, but this is less common compared to FOB shipping point. For most of the problems you see, it will be FOB shipping point, meaning customer, the purchaser, will be paying the freight charge. Okay, but in case the problem also states that the shipping term is FOB destination, then seller will be the party paying the freight charges, and they have the title of the goods all throughout the transportation process until it reaches the customer's home or the customer's company. Then the title of the goods transfers to the customer. Okay, so this case here, let's say the freight charge is $100. And seller is the party paying this to FedEx or UPS company. The transaction will look like this. You'll have a delivery expense account. This is a regular expense account. Regular expense account, normal balance is under the debit side, $100 there. And so in terms of the seller's perspective, if they are paying the freight charges, this is an operating expense for the company. Unlike earlier, as a purchaser, if you purchase an item into your warehouse, there's freight charges that you need to pay. We think of this as a package with inventory costs. This is a necessary charge if you purchase inventory into your warehouse, freight in charge. In this case here, this is freight out, because if you are the seller, you're paying the freight charges, this is the freight cost, related to shipping out the goods to your customer. Freight out cost is considered. Freight out charge is considered a delivery expense for seller side of the business. So in this case, your FOB destination, your customer will not be journalizing anything. They don't have anything related to freight charges in their book. But your book, you have delivery expense increased, reducing cash if you're paying cash immediately to transportation company. And we'll go over a few other operating expenses. So this term is also new for this chapter. We'll be separating expenses into two different categories, and delivery expense is part of the operating expense. Okay, so the net effect of all the sales transactions that we talked about earlier, going back to the first slide that I showed you in this cycle, overall we want to get to is what is the net amount of sales revenue that we're getting out of all those transactions. So you may have originally the sales revenue amount, and the simplest case would be you just made a transaction incurring sales revenue, getting the revenue back. If you don't have the middle part, that will be it. Okay, but if customers returns a part of the goods to you, you need to reduce that amount under sales returns and allowances. And if they do pay within a discount period, then you also need to reduce any discounts that you offer them. So then overall, the net sales revenue would be using the original sales revenue, subtracting returns, subtracting any discounts. That would really be the cash that you'll be getting from them. Okay, net sales amount. Okay, I'm going to give you a few seconds. I notice some of you are taking notes. So again, this transaction only occurs for FOB destination. In the case that your company is selling items to customer and the shipping term agreement is FOB shipping point, then customer will be paying freight charges and you don't have to record this. Okay, this journal entry only happens under this credit, this shipping term, FOB destination, when seller is the party paying freight charges. Otherwise, it will be the purchaser's company journalizing the entries on freight, not seller. Okay, FOB shipping point will be the purchaser journalizing entries. Okay, let's go back to sorry, not going back. This is a new problem here. And let's try to look at these bullet points and then journalize the transactions that relates to sales. Okay, so these three bullet points all relates to sales side of the transaction. You have the first one here. This company sells 2,500 books on account for $15 each. Okay, so each book, the retail price is $15. The problem tells you here. Second bullet point, it tells you that the customer returns 100 books to you and tells you the cost of the book. These 100 books were damaged, so but they returned to you, so meaning that in seller's viewpoint, you're actually collecting the inventory here, the second bullet point. Then the customer pays the balance overall later when it reaches October 22nd. There's credit term that you offered to this customer earlier. So you have to determine whether this transaction is within the discount period. Okay, so try to journalize this transaction on sales returns, and also finally the amount you're collecting your customer. There should be 5 entries here. First one relates to 2, second 2, third one 1. There's a 1 week practice questions that I forgot to give back to you last time, so I'm passing it around. Just pick yours. Okay. All right, let's take a look at the first bullet point here for sales transactions, and always any type of sales event, there's always two entries affected. You have one entry capturing sales revenue, the retail price that you're getting from customer. Another entry you'll be capturing the cost of the inventory. Okay, so here it tells you that we're selling, the amount of the goods is 2,500 books, and it tells you for each and every book worth $15, the retail price that you're getting from customer. So for the total sales price, you'll just be using those two amounts and times those two together. That will be sales revenue. Okay, for the cost, it tells you directly, altogether the cost inventory amount is 22,500. Okay, so first entry will look like this. You have accounts receivable, 37,500, using 2,500 books times 15. Then you have the inventory cost reduced, because again, you're now shipping out the goods to customer, you're reducing your inventory level, turn it into cost of goods sold expense. So whenever there's sold transaction, inventory will be reduced and it turns into cost of goods sold expense. This account here is specifically there to capture inventory costs that you shipped out to the customer already. We call it cost of goods sold.
It seems like the cost for 2,500 books, 22,500. Why do they say that? Like, cost of these books?
Why?
Yeah. Is it the inventory?
It is the inventory cost. So which is why you see the dollar amount here.
And the first part you have to calculate.
First part is the price that's labeled on the book. So if you're the customer, you walk into the store, the price of each book is $15. And then you're now selling, if I'm the customer, I'm purchasing 2,500 books. Altogether, 37,500 would be the price I'm paying to the company, right? But the 22,500 was the original price that the company used to purchase from their supplier, the cost. Okay, so that's the purchase cycle. And now this is the sales cycle, the retail price that you're getting, okay?
Thank you.
Okay, so most likely you will see a difference amount here because this is the whole point of a merchandiser's company. They're generating gross profit in between these $2 amounts. Okay, later on we'll talk about what the gross profit is. So basically it's the difference between retail price and cost. That's what they're gaining. Because this is the money that they spent earlier and this is the money that they're collecting from customer. Now the second two entries, the problem tells you that the customer returns a part of the goods and they actually ship back the goods back to the seller we're the seller, we're collecting the goods from them. So basically we'll be flipping these two entries. But specifically for sales revenue, we'll be capturing the dollar amount under sales returns and allowances. Okay, so again, as long as the problem tells you that the inventory is being shipped back to the seller, you would always have two entries for this. You definitely have one to capture also the inventory that's being collected back from customer. So the problem tells you that the cost of the good is $900, so you know this dollar amount already. You just directly use this $900 to increase inventory and reverse earlier's cost of goods sold expense. Okay, so inventory we increase here, cost of goods sold decrease because earlier we had a transaction on this. We're trying to reverse a part of this, $900. Now the $1,500 here, it comes from the retail price of each book is $15, and then you're getting $100, 100 books back from customer. So altogether, a customer later on will not be paying you this $1,500, which is why you're reducing the accounts receivable that you're getting from the customer. Okay, so sales returns and allowances, you'll see $1,500 here to reduce earlier the dollar amount that you captured in sales revenue accounts. It serves as a contra account, reduces sales revenue. At the same time, accounts receivable is being reduced because this is an allowance to customer. They will not be paying this damaged goods amount. Okay, so later on, the accounts receivable will be reduced from them. It will not be $37,500, but that amount minus $1,500.
Can you clarify the problem? So you're telling me that $900 worth of shipment is damaged?
$900, yes. The cost of the goods is $900. But the $1,500. No. We're now moving on to sales cycle, so it's no longer related to supplier.
Okay.
Supplier early on sold you the 2,500 books to you, and you're now reselling the 2,500 books to your customer. Okay, so if I own Barnes & Noble, I got the books for $900, and now earlier I got the books from $22,500. Now I'm reselling to my target customer, whoever that walks in. I'm selling them altogether this 2,500 books that worth, the retail price altogether is $37,500. I definitely need to mark up a price. After I get it from my supplier, I mark up a price that worth this, right?
Right.
And now the 100 books that customer received, they're not satisfied with it. Either it's damaged or there's an error. They now ship it back to you. So if I'm Barnes & Noble, I got the books back. So they will not be paying this $1,500 anymore because this is not the product that they wanted. I'm giving them an allowance for $1,500. And that book, the cost that I got back, those books that now I regained into my warehouse now, altogether the original cost is $900. Not getting it. So there's two cycles here. We purchase the inventory, then we sell it, right? So earlier when we purchased it, these 2,500 books, the purchase cost that I paid, Barnes & Noble paid to whoever their supplier is, they use up this money. This is the money that they use to get these books. And then they want to resell it to their customer. They supposedly should be getting this dollar amount from customer. Okay, but this is an on-account transaction, so the customer, Barnes & Noble, will be getting the money later on. Okay? Now, before they got the money, the customer inspected the goods. They realized 100 of them is damaged during the shipment. They don't want that anymore, so they return it back to Barnes & Noble, to your company. And this $1,500 is part of this $37,500. So you'll be reducing customer $1,500. Later on, they don't have to pay this amount in full because they ship back the goods to you. And the goods originally cost you $900 from here. Okay, so the $900 is from part of the cost that you purchased earlier. Earlier you thought this part of the goods shipped back. You don't have this inventory anymore, but now you got back $900 more because they shipped it back to you. Okay, so this is the original cost of each and every book that you used, the money you used to pay to your supplier. The $1,500 is the money that you're not getting from customers since they ship the goods back to you. Okay? So one is the retail price, one is the cost of the goods. Okay, so after these two entries, the last question would be, if the customer is now paying within the discount period, then what would be the dollar amount that they're actually paying to you if they get the discount? And so you have the sales returns amount $1,500 that you're not getting for sure. You know this for a fact because this is the goods that you collected back from customer. So the total amount that customer will be paying would be starting, the calculation would start from $37,500, the original amount, minus the returns, $36,000. Supposedly you should be getting this $36,000. After the discount period, you should be getting this. But since the customer is now paying within 15 days, you give them 2% off of this $36,000. Okay, so you see sales discounts here, 2%. The $720 you're also not getting from customer because they paid early. And so another case, the opposite case would be if they pay after 15 days, then it will just fully be $36,000, $36,000. Okay, but with the discount, you will have sales discount in the middle, capturing the amount of sales revenue that you're not getting. You have 720 here. So always when you calculate discount amount, don't forget to capture anything that's returned or any allowances that you grant to the customer. That has to be reduced first because usually that happens within a week after customer receives the goods. In reality, that will be reduced before they even pay the dollar amount. Okay, so before applying the discounts, always subtract any returns and allowances first. And then you use whatever amount is after that, $36,000 that you got, then you apply the discounts. And so meaning that the total cash that company is actually receiving from this entire transaction, even though it started from $37,500, a part of that your customer returned to you, so you're not getting a part of that back. Also, a part of this $720, you offered a discount to them. So overall, the cash that you're really getting from this transaction is only $35,280. Any other questions before I move on? Okay, so just like purchase transactions, for sales we start from selling regular sales transactions with retail price, with cost affected. And if there's returns allowances, and specifically if inventory is actually shipped back to the seller, then we flip a part of those two entries dollar amount. Your sales returns and allowances, and then you increase inventory again if the company receives inventory. If not, if this is a case without the seller actually collecting the goods, then you would not see this entry. You will only see the first one. Okay, so in the case that the goods are not actually shipped back to the seller asks the customer to just hold on to the damaged goods if they think that they can't really resell it to other customers. In this case, it will just grant them a reduced accounts receivable, and you won't see this journal entry. You will not have an increased inventory level. And so after returns and allowances, in case customers pay within discount period, just like how your company deals with vendors, if there's purchase discounts. For sales discounts that you gave to customer within the period of time, you also need to apply certain percentages here, meaning the cash that you're getting from sales from customer will be reduced. Okay, if not, if it's after the discount period, then it will be the full amount that you'll be getting. Okay, now we have been talking about differences between retail price and cost. Basically, the official term for the differences here is called gross profit. Okay, so those two entries that are captured in sales transaction, the dollar amount differences, and then after we accumulate many different transactions that happens, altogether the differences between retail price and the cost altogether is called gross profit. Okay, now don't confuse this with net income. This is not net income. It's not there yet. Okay, net income also captures all the other expenses in the middle. You still have rent expense, advertising expense, insurance expense, other types of supplies expense. Gross profit, by the time we calculate gross profit, this dollar amount only considers one expense account, only consider cost of goods sold expense. Okay, but cost of goods sold compared to other expenses is the majority amount of the expense. You will see it's significantly more than others, significantly higher than others because it captures inventory's cost. Okay, all the others compared to cost of goods sold would not be as high as this. So this typically is a signal of whether or not the company later on will be getting net income, because if gross profit is readily, let's say, negative or even close to zero, then there's no way that later on there will be a high amount of net income. Okay. Company captures net sales amount minus cost of goods sold, just one simple inventory expense account. Then from gross profit, we'll be subtracting all the other operating expenses. Then you get to net income. Okay, but if at this stage, when you get to gross profit, if it's already pretty low, then there's no way that their company will be getting a high amount of net income later. It would only be less than this. Okay, so gross profit typically is an indicator of how well the business is doing at an early stage before capturing all the other expenses. You'll be able to sense and also compare to early periods. If gross profit has significantly decreased, then you know this season the company has not been selling as well. Regardless of whether it's the price or the amount, altogether if gross profit compared to early periods has been reduced a lot, that means this season the selling events has not been doing as well compared to the past. Okay, so the official definition here is the extra amount company received from customer over what they pay to vendor, but really what they're saying is just the differences between cost and retail price. Okay, so for example, if the cost of purchasing a CD is $15, later on company mark up a price for each and every CD to pay $20, customer pays $20. Then for each sales transaction of one CD, you're getting $5 of gross profit. So if you sell 2 CDs, you're getting 10, 3, you're getting 15, 4, you're getting 20. Overall gross profit will be capturing the differences between the total cost and the total sales revenue, retail price and cost. Okay, since we're on the topic of gross profit, we're going to end today's lecture with a ratio. The ratio to base on also the profitability of the business. Okay, so this is not net income. Again, gross profit is net sales minus cost of goods sold only subtracting one expense account. Okay, so this ratio overall wants to tell us the company's profitability in terms of how well they're selling their inventory. Okay, so not in terms of the usage of operating expenses. We're just comparing gross profit, which is the differences between sales and cost of goods sold. Then we divide it by the total net sales revenue. So overall, this will tell us that for every dollar of sales that we make, the company makes, how much gross profit they're earning from every dollar of sales. So if the gross profit is 50, the net sales revenue is 100, then you're getting 0.5. For every dollar of sales, you're getting 0.5 of gross profit. So this ratio, the higher it is, the more profitable the company is doing in this season. There's no rule of thumb, not like current ratio, not like debt ratio. There's no rule of thumb to compare, to evaluate, just by looking at one number. Usually what the industry does is compare across different seasons, could be different quarters, different years of gross profit, and also cross-section with the same industry, their competitors. Okay, so there's no rule of thumb for this, but generally speaking is the higher the better, because the higher this ratio is that represents the relationship between gross profit and net sales, the higher the gross profit is for every dollar of sales. Okay, but we will be comparing it to to imply whether the company is being more profitable than the past or less profitable. It has to be based on comparison. Okay, so for earlier transactions, if our sales revenue $1,000, later on you have sales returns, allowances, sales discounts, we'll just be using the net sales for this ratio. Okay, again, not the original sales amount, 1,000. We'll be using overall what is the actual cash amount that you're getting from sales. This is what the net sales here mean. Okay, net sales captures all the issues that happen in the middle, and then at the end, what is the actual cash that you're getting from sales transactions? For this case here, we're using 890 instead of the original 1,000. Okay, so make sure to keep in mind it's net sales, not the original sales revenue.